AI isn't going to replace people. AI is going to replace people that don't use AI. So basically the case that they were making was all real estate firms should be looking at ways to introduce AI into their company, support their folks, make their employees stronger, better, faster.
Hey everybody, welcome to another episode of Wealth Unfiltered. I'm Samantha Parrinello, your host. In today's episode, we're talking about markets are supposed to move on fundamentals. But what happens when headlines take over and the fundamentals are sidelined? That's what this episode is all about. To start today, I'd like to introduce my guest, which is my resident guest expert and my husband, Chris Parrinello. Welcome back to the show.
Thank you. Yeah, happy to be here.
So this episode, we're really going to dissect how the headlines have been having a large impact on what we're seeing in markets, and specifically how the fundamentals are being shifted due to those headlines that we're seeing. And this really started when a few weeks ago, everyone heard about what happened with the assassination of Charlie Kirk. And one of the things that I saw the next day, actually within hours, was that there were like giant leaps in gun sales, and you saw those stocks rising. And I asked you, I said, gosh, like that is so weird to me. Like, why would that be the case? And that's really what sparked our conversation about how headlines can really trigger movement in stock market and shifts that you see. And so that being said, that's really what got us started on this conversation. But where I really want to go with this is truly talking about the power of headlines. So one of the situations that is most recent is that the Fed's just cut, 25 basis points. And there has been a lot of movement from that. So I'd like you to kind of dive into what was expected versus what really happened.
Yeah, and I think, my focus and background is always on real estate and real estate investments. However, I think the headlines play a particularly strong role in how people feel. A lot of people aren't digging into the key fundamentals, certain things that they're investing in. They're really looking for, like, their level of due diligence is like, okay, how much gain has this seen over this amount of time? It isn't like tied to the actual business operations or how well the company might do from those type of key fundamental aspects. So with the Fed and the interest rate revisions and cuts, it's similar. So everyone kind of sees the Fed's going to cut rates, or the dot plot came out and this is how many cuts we're going to have. And before anyone can even digest the information or the bond markets can even interpret the data, and that's really what is going to set treasury yields, is where bonds are trading. The market wants to be so ahead of the game that it starts pricing in additional cuts. It's more of like a fear of missing out.
Mm-hmm.
People want to be ahead of the curve. Like the illustration you brought up about, it doesn't have to be Charlie Kirk. It's anytime there's gun violence, people feel like, oh, well, people are going to be scared. People are going to be worried about their Second Amendment right being taken away. People are going to go out and buy guns because they think this might be the thing that finally takes away your ability to own them. So you got to kind of stock up. Like with COVID, it didn't make any sense, but when you went to the store, there was no toilet paper. It wasn't the thing that you'd think people would need the most, but because people were so worried that they wouldn't be able to buy anymore, they were buying 10 times more than they needed because of fear of not having enough toilet paper. So I think the headlines kind of play into those fears. And I'm on record, during our podcast kind of saying that a lot of human nature is kind of based on what I was taught as a kid, is it's fear and greed.
Absolutely. So like market
the headlines
sentiment
really kind of show that in real time.
Yeah. So like I was saying, market sentiment is really what is changing. It's the consumer expectation based off of what they're hearing versus facts.
Right.
Yeah. So
And people take common sense completely out of the equation a lot of times. Like, for an example, there's a lot of investors that invest with us that several months ago, when stocks took a huge dip, like the biggest thing I heard the most, 9 out of 10 people, man, I wish I would have pulled equities out before the tariffs announcement. Kind of knew this was coming. I didn't touch anything. If I could only just go back in time and change my mind, and reallocate elsewhere. I didn't realize that the correction was coming so soon. Fast forward to today, they've regained all their gains, but now they have FOMO of how high these could go. They forget that they were begging for a second chance like 6 months ago to reallocate to things that weren't affected by headlines as much and were tied to real assets. But now they're back on the roller coaster going up. And in many cases, I think a lot of people are going to wait until the roller coaster heads down to feel like they missed out on reallocating somewhere else. So it's just funny how
you actually just touched on. So I read, it says within 2 days, indexes went from 9 to 11% in value, over 6.6 trillion erased. And it's all due to the 2025 stock market crash pending Liberation Day of speaking of the tariffs. So it's just another like way of showing exactly what you're saying is that fear and watching what's happening with an announcement of tariffs. And I mean, man, was that like a roller coaster of emotions for everybody. And you saw it in the stock market as the emotions were eased, the fear was eased a little bit, like, oh, this might not go into place. There was more of like positive reaction. And as it got more fearful, it like had the opposite effect.
and that's where, and like, I think for the folks that watch this, the folks that, invest with me at Viking, what I always tell people is if you're proactive and you believe in the fundamentals and the things that you're investing in, then you have an advantage, a huge advantage over everybody else, because you believe that what you're investing in is going to do well in any environment because you believe in those core fundamentals. And there's going to be times where the headlines swing things down, where I see a lot of people made a lot of money when the tariffs caused stocks to dip, and they're like licking their chops. They're like, oh man, look at this huge buying opportunity. And they bought a bunch. I see it in multifamily now. Like people really wanted to invest in multifamily when everyone was reporting 2x returns and cap rates were dramatically correcting. The fundamentals haven't changed for multifamily. There's still a huge shortage of supply. The problem is that roller coaster up is now, it came back down. It came back down to reality with normalized interest rates and supply and demand in normalized times. And now you're able to buy properties that back then you would have been like, man, I bought that at a 4 cap. Now today I can get it at a 6 cap. People are scared to buy.
Right.
They're scared to take the plunge. They want to wait until it's obvious to buy again and that they're going to have missed the opportunity. So I think the people that are able to buy in the valleys and the dips and have conviction in what they believe is a good company to invest in, whether it's a stock, whether it's in bonds, whether it's in a hedge fund or in alternatives, having conviction and truly believing that you understand how this company makes money and why it's going to be successful in the future, this gives you an incredible advantage over all of the other people that are chasing the headlines.
100%. And so one of the bigger topics that I think has been an overarching topic for, I would say, we're going on 2 years probably, is the disruption of AI and all of the different stocks that you can invest in with AI. And there's been a lot of ups and downs with that as well. There was, some talks of how people started pulling away from American AI and jumping into the more like China AI because they felt like they were ahead of the game, and that came with the headlines. And then you saw a pullback again when now there were some major companies pulling back saying there's oversaturation and it's not going to happen, or, oh man, it's still too early to know. It's still too early to know what's going on. And so as these headlines keep coming out where people have that level of uncertainty that causes the chaos, that then all of a sudden you see this huge influx of money coming and going.
Yeah. And I mean, this is a great topic. I didn't really think about it prior to in the things we went over that we're going to discuss, but I was just, as you know, at a conference for COOs and CIOs in New York, and they had an entire panel revolving around AI in real estate. And it was fascinating because you had like really strong minds in this field, people that are creating AI, people that are, putting it over really large real estate firms. And one of the quotes that I really loved from that is, AI isn't going to replace people. AI is going to replace people that don't use AI. And I think that's very much true. And it really resonated with me. And everyone was kind of going through the other big, I think, theme that I think from an investing standpoint is helpful advice I took from it was, in many cases, it doesn't pay to be an early investor in something that isn't fully baked.
Right. 100%.
So basically the case that they were making was all real estate firms should be looking at ways to introduce AI into their company, support their folks, make their employees stronger, better, faster. But from an investor standpoint, it might be safer to wait, a couple years until you start to see which of the thousands of AI companies are actually going to take on. Because AI is so broad and there's literally tens of thousands of companies that are being built. And I think if I were going to invest and focus my personal dollars into AI investments, it would be into companies that support AI's growth.
Yeah,
So
agree.
not necessarily specific AI companies that I think could take off, because who's going to be left standing. I think what we can all broadly agree on is that AI is going to create a monumental leap. We're going to figure out how to best utilize AI safely and in which industries and how to use it properly. And that's something I think you can take to the bank. So if you invest in things that are going to allow AI to grow, infrastructure of AI, I think that's probably the safest bet.
Absolutely. So you talk about, keeping true to fundamentals. But what we're seeing in headlines is that people are forgetting them, right? So I would say one of the things that we should maybe discuss is how you can balance what you're hearing in a headline, but also to remember some core fundamentals while you're looking at it. Because there are some headlines that have truth. I'm not dismissive of headlines, but I have to say there has to be a way for people to stop, pause, and evaluate.
Yeah. So I would say, I relate this back to real estate because that's what I know more about. But when you look at the big key fundamentals for like a multifamily acquisition or development, it usually has to do with your basis, so your cost basis. So one of the reasons why deals at the height of the real estate boom, when interest rates were low, are facing adversity now is because there was so much demand. You were paying the highest price than you had been paying historically. And that is really shown in a cap rate. So deals back then were trading at sub 4 caps, 3 caps. And today those same deals are trading at between 5 and 6 caps. So being able to look out and forecast and say, okay, I'm buying this property at a better basis than 2 years ago, and it's well below replacement cost. And maybe you're measuring things like untrended yield on cost or yield on cost. And you're looking at things objectively and saying, okay, I might not be getting strongest cash flow today because there is still some softness in the market from a lot of oversupply, but there isn't a lot of supply coming behind it. So you look at those types of key fundamentals and you start building the case for why you could see another growth 5-10 years for what you're looking at. It's the same thing, I think, for traditional equities. They're not always just going to continue to go up, or at least they shouldn't. There's going to be blue chip stocks that have really great balance sheets that because of headlines have been depressed. I think a lot of people that put money into those, and you'll notice when you start noticing the really big allocators of capital, you can kind of mirror what they're doing. When certain things dip down to a certain level, really smart money will say, okay, this is now a value buy. And I think that's what you're looking for. That's why I think multifamily is a good opportunity, because you don't have a lot of disruptors in your way. You don't see a huge pipeline of historic supply coming online. Whereas if you're looking at hospitality or office, those are also depressed from a valuation standpoint. So I wouldn't necessarily pour a lot of money into those things unless I believed that office was going to come roaring back. Is everyone going to give up work from home and go back to work? If you believe that, then maybe office is a good place to put money. Do you think that hospitality, that we're not going to run into a recession and people are going to tighten their belt? If you believe that people are going to have more disposable income into the future, I would bet on hospitality, because usually when people have more disposable income, they'll go and spend more money. When people don't, or when you have inflationary times, that's usually where a lot of core real estate operates as a good inflation hedge.
Yeah, and I think one thing that we typically speak about, specifically when we talk about real estate investing, is a long-term approach. And I think particularly it's important not to just have that as your frame of mind when you're talking about real estate, but your long-term investment thesis overall. So knowing that fundamentals, the long-term fundamentals, are the long game. You aren't, I mean, unless you're doing day trading, and that's a specialty, right? You shouldn't be just day trading as like a hobby. Like, you really should really know what you're doing, because you could lose a lot of money that way. Is having a long-term investment strategy that you're implementing, and fundamentals are where you will find your success.
Yeah, slow and steady is always the way to go. And I would even make the argument that day traders are the ones who benefit most from the headlines.
Oh, sure.
Because they can actually see and forecast on a short time horizon, whoa, the
Right.
headline came out, let me put a call or let me put a put on this stock, because I bet 9 times out of 10 that because everyone's thinking this stock is going to go up temporarily. And I think a lot of them don't need to trade on core fundamentals. They're almost trading on human emotion.
100%. And that's like almost pattern recognition, right?
It
Looking
is
back,
exactly what it is.
looking back at what has happened with other, like if it was for the guns, for example, what were the time horizons for that? Because I mean, what I was reading, even just for that instance, was that, it was within 12 hours, they saw a major, major uptick, but within 24 hours, it started to resettle. So I'm sure that has been something that, as a day trader, if you saw that in past situations that were similar, then you knew, okay, I have a 12-hour window to say I'm going to buy it and I'm going to release. Something that you and I do on a daily basis. It's not something that we may have made a hobby of our own, but we do have friends who we know who participate, and that is definitely part of their strategy. But I think when you're talking about fundamentals for investment and people chasing headlines, that's where people get into a lot of trouble. I've seen people lose a lot of money thinking that the media is helping them through something when really they're just trying to tell a story.
Yeah, 100%. And I think that's the media's job. And I think it's almost our fault for thinking anything less of them. They're trying to capture eyes. They're trying to make their business run. And their business runs by creating excitement and emotion. So I think, and it goes both ways. It isn't just positive news going to drive things up, negative news around something that could potentially be positive. Like, I had a chat with an investor who transparently, like, a couple of deals in the portfolio that we had bought in 21 and 22 were facing some adversity. And he was so beat up by the news. He was like, we're not letting any immigrants into the country, so population growth is going to stall. Houses are getting more expensive. All of these long trends where he's like, there is, based off the news, it was like there was no hope that everything was going to fail. We're going to go into a recession. All of the stocks are going to get recorrected. All of the commercial real estate industry is going to entirely blow up. And it's just going to basically be the worst decade in history. We talked for almost an hour. I was like, some of these things that you're mentioning are very true. Like, they're things that I actively track. Population decline in certain areas, or immigrants not getting as many H-1B visas because now there's a fee associated with it and they're being canceled. These are going to have a cause and effect, but it isn't all doom and gloom. Like, there is going to be kind of an upside. So like the really high expense for someone buying a home, even though that is true and people aren't able to buy homes, has a positive effect on rental industries. Because rental industries are going to have more people that are forced into them. Same thing with
Especially as housing is a demand that has to be met.
It has to be met.
Right.
So I was like, demand for foreign H-1B visas, where these are like usually high-paying jobs, physicians, tech executives that usually get to come here on an H-1B visa. I'm not saying I believe that they should be curtailed or not curtailed, but if the fact is that there's 500,000 less of them, that's 500,000 more jobs that are going to have to be filled with a workforce that is already here. So that means more people that may or not lost a job to someone that was on an H-1B visa. Now you're going to have a group of people in the United States. Those jobs are going to get filled. The idea that AI is going to dramatically limit the workforce and replace people, you're going to have iterations, and there might be pockets of time where it is tough to find a job, and AI has eliminated the use for that. But those companies that are able to hire less people and get the same amount of work done with less people are going to be able to be more successful and pay their people better and create more revenue. So the people that are investing in those companies are going to get more returns, because you never want to kill efficiency or progress just to have a W-2 for someone,
Right.
you know? Like that isn't what you should do. The more the company makes, the more it should be able to give better jobs to employees. All companies' goal is to scale.
Well, I was going to say, and I would hope that if they were able to do more with less people, then they could create more physical sites and bring more humans on. There is like a give and take, but I would think that as people become more efficient, then they can scale, and scaling means more opportunity overall.
Yeah. And I think the main thing that I got across to him, and I think, we left that conversation and we both felt like we learned a lot. Like I learned a lot of what he's tracking, some of the news that doesn't get to me. He learned a lot of my viewpoints and kind of playing devil's advocate on some of the doom and gloom. And at the end of the day, what I think we both agreed on is things are going to change, and you need to be able to stay nimble and iterate on what those changes are. And protecting your wealth is one of the main ways that you need to stay in the know and understand where the risk lies, where the reward lies, and how to balance that out so you continuously grow your wealth and you don't just lose a ton of it.
Are you looking to build sustainable wealth and achieve financial freedom? Viking Capital can help you do just that through multifamily investing. With a team of seasoned real estate experts, Viking Capital conducts deep financial analysis and data-driven asset management to deliver outstanding returns. Their strategy focuses on low-risk opportunities with significant value-add potential, preserving your capital while maximizing long-term growth. Join them and be part of a success story. Viking Capital has acquired 30 properties and manages over 6,000 units, all thanks to their dedicated team and valued investors. Discover their current deal offerings at vikingmultifamily.com and start your journey to financial freedom today.
I had a guest on our show a couple of weeks ago, Dana Cornell, and one of the things that he and I spoke about were building your portfolio. And I think the one thing that I took that I really, really, really liked about what we talked about was there are no two portfolios that are the exact same. There shouldn't be. Everybody has to invest based off of their needs. But when you are creating your portfolio, having guardrails such as assets that are cash flowing and income earners and income generators for yourself so that you can have another source of passive income. Also having some that are just like set them and forget them, and they are long-term approaches that you can then 1031 into another, and compounding wealth growth. You have some that are specifically meant for tax mitigation and saving that money, keeping that money in your pocket. And as we continue to, help people with their investment journey, and that's like what the goal is for the show, is for us to continue to help people have alternative, people talking to them about methods, opportunities, our own insights to how we view things, what other investors are saying. I think it's really powerful for you to be able to give people insight into what other people just like them are thinking, doing, how they are, putting their money into assets. And I think ultimately the goal is to give people those guardrails.
Yeah, 100%. I think Dana was spot on. So the big things that I would take from the show that you did with him, and what I think everyone should really, think about and build into their process, is understanding how to leverage tax mitigation into your strategy. And then understanding you want a portion of your portfolio to be very growth minded, and it's going to spur decades of growth for generations to come. And that one's also probably going to hold the most risk. And then you're going to want to have a middle point, which gets you cash flow and kind of risk-adjusted returns. I think this is what alternative investments and real estate offer. And then you're going to want to have something that's like very safe, that creates, maybe it's cash flow. I think more important than whether it creates high cash flow or not is that there's liquidity. And I think that bucket of safety, having liquidity, is important because you might pull from that bucket in opportune times where you say, oh, this thing just got discounted, I want to allocate here. You might not want to allocate from your growth strategy, but you can pull from your safe liquid assets and put it somewhere where you want to take a little bit more risk with it. Then when you've reached that potential, you can always pull chips off the table from any of those other sectors and bolster the risk assets. I think that's what larger groups will do, is when they see an opportunity, they'll take that risk with however many chips they want to push towards the table, and then they'll rebuild up their risk-averse assets. So you have your portfolio in those sections, and then on top of that, you're consistently trying to pay as little as tax as compliantly possible.
Absolutely. Creating wealth through tax mitigation is 100% something that I think most people have forgotten you can do.
Well, and it isn't like a lot of people that I talk to, whether they're sophisticated investors or not, they're like, well, if I get out of paying my taxes or I don't have to pay these taxes, I've offset my tax liability. You're really deferring them. So I don't look at tax mitigation strategies as a way to get out of paying taxes. I think what you're doing is it's almost like an accelerant for your entire portfolio, because what you're able to do when you defer taxes to a future date and then you find ways to continue deferring them is every time you can do that, you're redeploying capital into the market and you're putting accelerant on it. So you're growing it tax-free for some amount of time. And the goal is, like, if the miracle of compound interest is that if you can redeploy capital quicker and it's growing tax-free as if it was in a Roth IRA, when you come out of those deals, you have a bigger amount of upside than you would have normally had. And then there are lots of strategies that allow you to keep investing, and you can even get depreciation or you can get other tax advantages from other investments that allow you to continue kicking down the road, where you might not be able to take the $2 million you have and go buy 2 Ferraris with it, but you will be able to take that money and invest it into something intelligently and offset some of the tax in that way, which will grow your money faster.
Absolutely. So I have maybe an interesting question for you. In the last, let's say 2 years, maybe 3, has there been one headline where it was humbled you, where you may have bought in a little bit too much into it and now you're like, man, that was probably a mistake, or wow, that could have been a real mistake with how I was buying into the headline?
I think one thing that not only, it doesn't catch me anymore, but I think earlier this year, September of last year, when the Fed came out and cut 50 basis points, I thought that we were going to see the beginning of an easing cycle.
Mm-hmm.
And I even understand how the correlation to treasuries and the bond market, real estate, I just didn't ever imagine that interest rates were going to stay high for so long. And I think part of the reason that what I thought was going to happen and what actually happened is the reality is the data that is coming into the Fed that's causing them to choose whether they cut rates or not is not supporting the case to cut rates. So that's why I found it very interesting that the statistician was fired and part of the government is saying that we can't trust the data. Like, huge problem. But I think that the answer isn't just to cut rates. I think what everybody in the world in commercial real estate thrives on and is craving is stability. They don't want low rates that are super low that aren't realistic. They don't want high rates that are really high and aren't realistic. Like, they want to have a normalized rate that is low enough to where they can still build the case for buying whatever they're trying to buy. And it's high enough to where, you know, the lenders and the people that are lending on this rates can still operate and make enough return that makes sense for them to give out the lending. So I think that's what everyone craves, but I think that's the one that fooled me once and doesn't continue to fool me. Now, when I see the Fed's going to cut rates, I just assume for treasuries to go up. I don't expect them to come down for some time, because really what's driving the treasuries is sentiment.
Right. Fool me once, right?
Yeah. Like, a jobs report that comes back lower than expected is going to drive treasuries down more than the Fed cutting 50 basis.
So I think what we have learned from this episode is, you know, headlines, they ignite the markets, but fundamentals will either sustain them or they'll kill them, depending on if they're actually worth doing.
Yeah.
Yeah.
I think we both agree on that.
Well, I want to say thank you to Chris for joining me today, and thank you to all of our listeners. Thank you very much for continuing to listen. Please like us and follow us for more. Send in any questions that you have for future episodes. Thank you so very much for listening.
Thanks, everybody.
Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.